Welcome back to our channel, where we bring you the latest insights on finance and investing. Today, we have an eye-opening topic to discuss, one that has been causing a buzz in the financial world. Strap in, because we're about to dive deep into the current state of the stock market and uncover a potentially concerning truth. But before we proceed, remember, this video does not offer financial advice. Now, let's get started. The stock market has been on an incredible run in recent years, reaching all-time highs and attracting both seasoned investors and newcomers alike. But what if I told you that it may be overvalued by a staggering 50%? Yes, you heard that right. In this video, we'll explore the reasons behind this claim and discuss the possibility of a stock market sell-off triggered by additional banking failures. Before we delve into the potential risks ahead, let's take a moment to understand the current state of the stock market. Over the past decade, stock prices have skyrocketed, propelled by unprecedented levels of liquidity and low interest rates. Central banks around the world have injected massive amounts of capital into the financial system, driving investors to seek higher returns in the stock market. As a result, we've witnessed a substantial increase in stock valuations. Price-to-earning ratios, a common metric used to assess the value of stocks, have reached historic highs. This raises concerns about whether the market has become detached from its underlying fundamentals, setting the stage for a potential correction. Now, let's explore why an overvalued market can be dangerous. When stocks are trading at inflated prices, it becomes increasingly difficult for investors to find undervalued opportunities. Moreover, the high valuations imply that future returns may be lower than historical averages, leaving investors exposed to potential losses. A market correction, or even a crash, can be triggered by various factors. One such factor is the risk of additional banking failures. History has shown us that financial crises often have a domino effect on the stock market. Let's take a detailed look at 5 examples from the past 200 years. Let's travel back to the 19th century and examine the Panic of 1837. The United States was experiencing a speculative bubble fueled by excessive lending and speculation in the frontier lands and transportation projects. However, in 1836, the Bank of England tightened its monetary policy, leading to a contraction of credit in the U.S. This triggered a series of banking failures, the collapse of land prices, and a severe economic depression. The stock market suffered a substantial decline during this period. The panic highlighted the interconnectedness of financial institutions and the vulnerability of an over-leveraged banking system. The subsequent economic downturn lasted for years, demonstrating the long-lasting effects of banking failures on the stock market. Moving forward to the early 20th century, we encounter the infamous Wall Street crash of 1929. The 1920s, often referred to as the Roaring Twenties, were a time of great economic prosperity and soaring stock prices. However, excessive speculation, buying on margin, and an overextended economy eventually led to a stock market crash in October 1929. The crash marked the beginning of the Great Depression, which lasted for years and had a profound impact on the global economy. The crash of 1929 serves as a stark reminder of the devastating consequences of a stock market bubble and the subsequent banking failures. The collapse of major financial institutions and the loss of confidence in the banking system had a cascading effect, leading to a severe economic downturn that took years to recover from. Fast forward to more recent times, we come across the dot-com bubble of the late 1990s. Internet-based companies experienced an unprecedented surge in valuations, driven by investor optimism and excessive speculation. However, when the bubble burst in early 2000, countless internet companies collapsed, leading to a market sell-off and wiping out trillions of dollars in wealth. The dot-com bubble serves as a cautionary tale of how overvalued markets can lead to irrational exuberance and subsequent market corrections. The bursting of the bubble revealed the fragility of high-flying tech stocks and the need for a more grounded assessment of valuations. Another prominent example is the global financial crisis of 2008. The housing market, fueled by risky lending practices and financial engineering, eventually imploded. Major financial institutions faced insolvency, and stock markets around the world plummeted. Governments intervened with massive bailouts, but the damage was done. The 2008 financial crisis showcased the systemic risks posed by over-leveraged banks and complex financial products. The collapse of Lehman Brothers and the subsequent ripple effects throughout the banking sector caused a sharp decline in stock prices, leading to a global recession. This crisis reminded us of the interconnections between the banking system and the stock market and the potential for a domino effect when institutions fail. Lastly, let's discuss the COVID-19 pandemic and its impact on the stock market. In early 2020, the outbreak of the coronavirus sent shockwaves throughout global economies and financial markets. Stock markets experienced significant volatility, with massive sell-offs occurring as investors feared the economic impact of the pandemic. The pandemic-induced market crash demonstrated the fragility of the market and the potential for swift declines triggered by unforeseen events. While the primary cause was not banking failures in this case, it highlights the vulnerability of overvalued markets and the need for caution. So, what signs are we seeing today that suggest the markets may be overvalued and vulnerable? One indicator is the increasing amount of corporate debt. Companies have taken advantage of low interest rates to issue bonds, often using the proceeds for share buybacks or other financial engineering activities. This has led to an unsustainable level of corporate leverage. Additionally, the rise of passive investing and the popularity of exchange-traded funds, or ETFs, have created a potential liquidity mismatch. If a significant number of investors rush to sell their ETF holdings during a market downturn, it could exacerbate the sell-off and result in a rapid decline in stock prices. In conclusion, the stock market's current high valuations coupled with the risk of additional banking failures should serve as a wake-up call for investors. While we cannot predict the exact timing or severity of a potential market correction, it is crucial to be aware of the risks and take steps to protect your investments. We have explored 5 historical examples spanning the past 200 years, each demonstrating the potential consequences of an overvalued market and banking failures. By understanding these events, we can better navigate the current market landscape and make informed investment decisions. We encourage you to share your thoughts and opinions on the health of the stock market and the broader economy in the comment section below. Remember, healthy discussions contribute to a better understanding of complex financial matters. But before we part ways, we want to emphasize that this video does not offer financial advice. Please consult with a qualified financial professional before making any investment decisions. Thank you for joining us today. If you found this video informative, be sure to hit that like button and subscribe to our channel for more thought-provoking content. Until next time, stay informed, stay curious, and happy investing.